Hi, good morning, good evening, good afternoon. I believe we are a global audience today, and it's my pleasure to welcome you for today's webinar, Practitioners Insights, Crypto Assets, Now and the Future. This is hosted by CFA Society India, as you all know. And again, welcome to everybody. I am Sandeep Gupta, CFA Head MB Invest at Magic Bricks, and I'll be the moderator for today's event. Before we jump in, I'll just have a few housekeeping notes, and before I introduce the speaker. So the session today is for 60 minutes, and we will be leaving time for the question and answer after the presentation. And I would request you to keep the questions flowing in because it should be an interactive session. And you can do so anytime by clicking on the Q&A link at the bottom of your viewer. This webinar presentation will be available to you to view after the presentation concludes in the chat box. And eventually we will also be uploading it onto the CFA Society website. And before we start now, let me introduce our speaker, Marcos. So Marcos is the Managing Director with Evanston Capital Management, an investment management firm in Chicago, focused on providing multi-manager alternative investment programs. Previously, he was a Managing Director at Cambridge Associates, where he led the firm's research effort in the crypto blockchain space and released the paper Crypto Assets, Venture into the Unknown, which mapped out the crypto blockchain investment landscape. So interestingly, you would have seen that we are talking about crypto assets here and not just cryptocurrencies because it's a larger field. Mr. Veremis holds a BA from Oxford University and an MA and an MBA from Columbia University. And before we jump into the presentation, there's a small survey that we will be running right now. It will help us understand the audience better. So Vidhi, can we run the survey now? So there you go. So I hope all of you have been able to fill in the survey. It's a small 3 questions just to get us a better feel of the audience that is there. Okay, over to you, Marcos. Now you can start presenting.
Well, thank you, Sandeep, and thank you, everyone. It's a real pleasure being on this webinar with India. I've been to India 3 times, as I was telling the folks here, so it's a really big treat for me to be able to do this. So, as Sandeep mentioned, you know, we have this quick poll. Please feel free to answer here, and I think at the end, if we have time, we can comment kind of on the results of this poll. So, we have a lot of material to cover in 40 minutes or so, because I would like to leave about 20 minutes for Q&A at the end. This material, I should note to you, could take weeks to cover, especially the technology behind Bitcoin, but we will do it in 40 minutes. So I'll do my best to cover kind of the key areas here. The way we have structured this is we want to talk first about blockchain technology and how it underpins crypto assets. Then we're going to move into the parallels between crypto and blockchain and the internet. Then we will talk a bit about the characteristics of crypto as money and the various forms of crypto assets that have developed over time. And finally, we will touch upon regulations. And as you know very well, India is in the midst of regulations right now with respect to crypto. So without further ado, I will jump into the technology and cover this part. I'll spend maybe a little more time on this because it's more complex, but I think that once you understand some of the basic principles, the rest of the discussion is going to flow very well, in my view. So let's start with the technology. So Bitcoin was the first blockchain system. That's something to be aware of. There have been many other blockchain systems since Bitcoin, and more advanced types of blockchains, and I'll get into some of this discussion. But Bitcoin was developed in late 2008, and you should know that before Bitcoin, there were numerous attempts to create and develop what is called internet money, so peer-to-peer money over the internet. There was Hashcash, BitGold, B-Money, many other attempts. But they all had their shortcomings, and most importantly, all required some specific third party to maintain a database. Now, Bitcoin for the first time solves this problem of having a third party intermediator. And it does that by doing three things: by combining ideas from peer-to-peer technology, and here for those of you who know about computer science, think of Napster, think of BitTorrent and other peer-to-peer technologies. Combining these technologies with game theoretic incentives and disincentives, and also with cryptography, which has also seen a renaissance during the rise of the blockchain. Bitcoin, important for you to note, is that it was a breakthrough in computing, first of all. It was a breakthrough in computing. And by being a breakthrough in computing, it enabled applications such as peer-to-peer transfer of value. Now, talking about cryptography, Bitcoin and all open decentralized blockchains inevitably rely heavily on cryptography. And why is that? It's because the power is with the users. Decentralized systems give the power to users. So the owner of a Bitcoin is the person who owns a private key that only he or she knows, and that if inputted through the SHA-256 algorithm, which is an algorithm designed by the National Security Agency in the United States, realizes a public key. It's always the same public key that is realized. The public key is evident on the ledger of transactions, and that's where people can send Bitcoins to you. But importantly, it is computationally impossible for someone to infer the private key backwards from the public key via the SHA-256 algorithm. And what does that mean? It means that only the owner of a private key can initiate a transaction. And that means that only the owner of a private key owns the Bitcoins. Now, this means in theory, and hold that thought for later, it means that in theory, I can memorize a private key, not even keep a record of it in the physical world, and own assets of all sorts of scale, even billions, in my memory that no one can take away from me. That is a very important concept with respect to Bitcoin and other crypto assets, because it involves the debate, A, of money laundering, but also B, the debate about economic freedom under authoritarian regimes, and I'll get to that. How the technology works, I'm gonna be brief here because it's quite complex. Different blockchains work differently, as I said. Throughout this discussion, I'm focusing more on the Bitcoin blockchain, the first one, which is the simplest one to describe. There have been many significant advances since then, but generally the way they work is that the system always involves independent nodes, often referred to as miners, or suppliers of the network. And those independent nodes that are, anyone could be, but by the way, an independent node in the network if they wish. These nodes verify that the transaction somebody broadcasts, like myself, is valid. And that means, for example, that I have the balances on the ledger to send to somebody else. These nodes, these validators, these suppliers, then compete with each other in the case of Bitcoin to solve a complex algorithmic problem that requires expanding substantial computing power. And the node that first wins by solving this algorithm earns the right A to input the next set of verified transactions into the official ledger. So think of them being able to insert the next page of the ledger in the official records. And by doing so, they're also paid for their service with newly printed Bitcoins in the case of Bitcoin. So we talked about cryptography. Hopefully game theory is evident to you here. There's a cost and a reward. The cost is the computing powers expended by these validators, and the reward is the new Bitcoins. This creates a feedback loop where the miners want the Bitcoin price to go up, the users want the Bitcoin price to go up, and everyone in the system has an incentive for the Bitcoin price or other crypto asset price to go up. So it creates this feedback loop. Now, very importantly, so long as 51% of these nodes remain honest, the system functions, and it should be noted that the Bitcoin blockchain itself has never been hacked, meaning nobody has ever managed to hack the ledger itself and alter transactions on the Bitcoin blockchain. What has happened is that people have lost their private keys or have had their physical records of their private keys stolen, and therefore they've lost their Bitcoins. But the ledger itself has never been hacked. And why has it never been hacked? It is because in order for somebody to get a hold of 51% of the network, in the case of Bitcoin, the values vary depending on the price and the computing power, but it would be kind of more recently, I was looking at it, it would be in the order of $6 to $7 billion for somebody to acquire the hardware and expend the computing to attack the Bitcoin network. So it's very secure. What are the stakeholders of a public blockchain network? I touched upon this a little bit by referring to the miners and the users and the investors. You can think of public blockchains in a simple manner. You can think of them as three-sided marketplaces. The miners that we mentioned perform the main service for the network. In the case of Bitcoin, the main service is to verify transactions, make sure they're valid, and then to enter the valid transactions for whoever wins the algorithmic race into the official records. That's the reason why they don't require the third party. It could always be a different miner who wins the algorithmic puzzle, and it could be anyone in the world. The miners that we mentioned, as I said, are the suppliers of the network. The users you could think of as the people who own the Bitcoins and send them to each other. Now, the users quite often are the same as the investors. The investors are the people who hold these assets for the long term or short term and provide liquidity in the open markets. Now, why are the investors important? Because take a miner who receives a reward in Bitcoin might sell that Bitcoin to an investor for cash in order to cover their electricity and other costs of computing. So this flywheel, this feedback loop creates these aligned incentives that push the network forward. Now, crypto has progressed a lot since 2008 and 9 when Bitcoin was the first launch. There was a second wave in the 2013-2014 period in which a number of new blockchains came to bear. The most well-known one is Ethereum, and Ethereum is a very interesting blockchain because it has many more applications than Bitcoin. Bitcoin's only application is to transfer value peer-to-peer. Ethereum's application is much broader. It allows for all sorts of complex conditional transactions or contracts between parties. You can also see there an M and an N. These are Monero, for example, which are privacy coins, because Bitcoin, although folks consider it private, it's not really private. People can actually track all the flows, and then if somebody liquidates in an exchange, they can identify that person. But Laying that aside, the most important wave by far, in my view, is wave 3. In wave 3, which was after the 2017 bubble, you had numerous projects develop that pushed the space further. And you had, for the first time, mainstream entrepreneurs and mainstream venture capital investors entering the space in large numbers. So I think wave 3, in my view, is the catalyst for an explosion, a Cambrian explosion in this space. And we are at this stage now. I think a lot of the media coverage of the space is still behind, and maybe in a lot of cases back in wave 2 and wave 1. Why does this all matter? There are many reasons why blockchains and crypto assets matter. There are many reasons that they matter because they are a horizontal technology. And by that, I mean that they hit on many different industries. They're not just a vertical technology in a specific industry. They're a new way of computing, a new way of exchanging peer-to-peer value that could affect many industries. But if there is something that you should keep in mind here without going into all the applications of blockchains, in my view, is that for the first time in history, you can actually exchange value in an internet peer-to-peer native way. Think of voice over IP, think of Skype. Skype was the first time you could actually have voice over IP, speak to people over an internet connection. Blockchains and crypto are the first time where you can actually exchange value purely over an internet connection. And that's a very powerful concept that we will touch upon later. Now, since we mentioned peer-to-peer protocols like voice over IP, and then there are obviously many other internet protocols, I think this is a great segue to the next topic I wanted to discuss, which is the parallels of crypto and blockchain and the internet. This is a piece from a Newsweek magazine, whom I think many of you would know, article from 1995. That was before the internet became mainstream. And I'd love to read you this paragraph very quickly because I think you will find it insightful and potentially also funny given where we are today. So the article discussed the limitations of the internet broadly, and among many paragraphs in there, one said, "We'll order airline tickets over the network, make restaurant reservations, and negotiate sales contracts. Stores will become obsolete. So how come my local mall does more business in an afternoon than the entire internet handles in a month?" That was the case in 1995, by the way. And then even if there were a trustworthy way to send money over the internet, which there isn't, and we now obviously know that there is, the network is missing a most essential ingredient of capitalism, salespeople. Now, why did I put this paragraph in here? Because at the time, the internet was promising to enable the decentralized and efficient creation and exchange of information. And it was not evident where that would lead. A lot of people thought it was groundbreaking, but the applications of it were not that obvious, and its scale was pretty limited at that point. You could argue that the crypto blockchain space is in a similar position with respect to the decentralized and efficient creation and exchange of value, meaning it's still very early, it has problems, and it doesn't have mass usage yet. But the idea behind it, one can think of as potentially transformational. Talking about the internet protocols, the blockchain and the internet. I mentioned HTTP, I mentioned voice over IP, but looking at this, this exhibit here, you'll see that the internet was something that developed over a long period of time. The internet started in 1974 with what is known as the Internet Protocol. And then a number of other protocols developed it to the point where it became the web. In 1989, HTTP actually made the internet a mainstream experience. And actually Netscape came over a few years later to actually really launch it into what it is today. You can think of the these early blockchain protocols as similar to the internet protocols, with a difference that it's not just about exchange of information. It's also about the exchange of various forms of value. So Bitcoin, a value storage and transfer protocol. Ethereum, a decentralized application protocol. And then since 2014, there are many blockchains competing for becoming the standards for various use cases. Even for digital goods, think of a painting, a painter would paint digitally only, and that they could sell as the one and only unique painting over one of these value protocols. That was not possible before because you could cut and paste many PDFs and many files in the Internet of Information. And why are these blockchains protocols? They are protocols because they are not owned by anybody. They're owned by a community, and they're open standards for everyone, like the building blocks of the internet. Now, the blockchain and the internet have many differences. It's not that there's an exact similarity here. Internet today is very fast. It has 3 billion users. It's not immutable. It's not very secure, as you know. And on the other hand, blockchains are pretty slow still, meaning because they're so decentralized, kind of the weakest computer in the computer network slows things down. You should note here that there are many projects trying to address this problem that have evolved, quite dramatically. It has a pretty low distribution because we are at 50 million users versus 3 billion. And of these 50 million users, I would say maybe a tiny portion has like more than one crypto asset, more than maybe $2,000–3,000 value of a crypto asset. They're immutable because they involve value, meaning once something is sent, it cannot be reversed. They're seizure resistant, and they can be private depending on the blockchain. Now, again, going to the question of why is all this important and what are the parallels with the internet? In the case of the internet, we all now know that this decentralized exchange of information that occurred with the internet and the decentralized creation of information severely disrupted, first of all, media, and secondly, retail as well, and numerous other industries that are being disrupted. Now, with blockchain, the first evident disruption that we can see, and there are others as well, are in financial services. So with respect to banks, brokerages, derivatives, private payments, and so on. And there are numerous projects that came out of wave 3 that I mentioned before. Coinbase is actually out of wave 2. It's been around for a while, that are actually decentralized versions of these intermediaries. And decentralized versions allow for peer-to-peer transactions, and they also allow for hopefully lower cost transactions, a global reach, and more importantly, permissionless innovation on top of these platforms, where developers can build on top of other products without requesting Bank of America for permission to do that, which they would never be granted. That's just an example. Crypto users versus internet users. Internet, 1990 to 1995. I'm taking 1990 because of HTTP in 1989. That's kind of when the web comes to existence. The web that we all use today. So if you look kind of at a similar time period, you'll see that the internet, in 1995 was at about 20 million users. And so has been the trajectory of crypto so far with respect to owners of crypto assets. Since we're talking about internet and blockchain, we need to bring in the venture capitalists. So this exhibit shows a number of generalist venture capitalists in Silicon Valley. A lot of these names are blue chip names and you might recognize, but the purpose of this exhibit is to show that particularly in wave 3, actually for the vast majority of them in wave 3 that we mentioned before, have begun investing in crypto related companies or even protocols themselves like Ethereum and Bitcoin. And it should also be noted that there have been a lot of spin-outs from some of these companies of funds that are crypto native, that only do crypto and blockchain in the past couple of years. I think this is a very brief overview and covers kind of some of the parallels between blockchain and the internet. But now I wanted to jump to, and in the interest of time, to jump into the cryptos as money debate and the various different types of crypto assets. So a few things. Again, here we're showing Bitcoin specifically. What you should be aware of is that there are different types of crypto assets, and I'll get into some of these in more detail. There are crypto assets like Bitcoin, which is not a good crypto asset as money. It's not good as a crypto asset as money because it's slow. It's very decentralized and it requires a lot of computing power and in general is slow, but it also is very volatile. Bitcoin could be viewed more as something akin to digital gold. Stable coins, on the other hand, which is an emerging area in crypto, can be viewed as internet money, and stable coins are pegged to an actual currency. There are different models for doing that, from Libra that is expected to have all its digital Libra assets backed by actual currency, to MakerDAO, which does not rely at all in the financial world and actually uses a very interesting algorithmic mechanism that pegs a DAI always to $1. So you can think of crypto as money more, I would say, in terms of stable coins. But let's take, why have, a lot of people ask the following question, why have a digital asset? Let's take Bitcoin. We have gold. Why should we have Bitcoin? And here in this exhibit, we show kind of some examples from gold all the way to land outside the country and how crypto, Bitcoin in this case, fares. I'll focus on gold here because it's the easiest one. And here are some of the characteristics of crypto that are different from gold. It's difficult to seize. I mentioned private keys before. Gold is stored somewhere, and gold can actually be found in a centralized place. Can also be found in people's matrices, but it tends to be in centralized places that can be physically captured. It tends to be private, although again, as I said, this very much depends. It's easy to transport. Think of what I mentioned before about owning assets via the memory of your private key. It's easy to acquire at this stage. It's easy to transfer. Now, we say somewhat in crypto because you need to find an exchange to liquidate it into actual cash. That's usually where the anonymity of crypto falls apart. It's uncorrelated with other assets and has limited volatility. And don't forget, it can be infinitely divisible, and it can be sent through somebody's computer to another person all over the world, unlike gold. I mentioned stable coins as money, as internet money. This is an interesting exhibit that shows the increase in stable coins since they started in July of 2017. You can see that they've reached, over 10 billion at this point in terms of supply. And what I find really interesting here is that you see a very big jump in their supply during the most recent COVID crisis. Why? Why would they jump so much? Because they're bearer assets. They're really equivalent to actually holding a US dollar or another currency. They act in exactly the same way as physical cash, but they do it through an internet connection. So they are global, they settle fast, and do not require any sort of physical contact. So an idea here is that COVID, given that it's stopped physical contact, has enhanced the growth of stablecoin supply. If we move to the next exhibit, this is what is called the decentralized finance space. And what is this space? It's an area that emerged in crypto in the middle of 2018, so in the third wave of crypto. where many applications are being built on Ethereum, which involve derivatives, lending, and various sorts of contracts. And these are purely peer-to-peer. They don't require an intermediary. And they allow open innovation on top of them. So in theory, they could potentially disrupt finance as they grow. Now, these assets fluctuate, but they are more recently, at the $1 billion level as a collateral locked inside some of these decentralized finance applications. I mentioned before that crypto assets are not just money. If there's one exhibit to look at from this section, it's this one. Crypto assets can be currencies, they can be commodities, they can be utility tokens, they can be security tokens, which actually represent the value of underlying off-chain assets on a blockchain and make them more liquid, divisible, and more accessible. There can also be utility tokens such as work tokens. You can think of work tokens actually as securities. Think of a supplier in a blockchain crypto network who stakes tokens that have a certain value in order to earn the right to perform work in the network and to collect fees for the work they produce. So it's kind of discounted cash flow analysis in this situation. It's more akin to a security. Then you go all the way to the top, you have store of value, that's Bitcoin. You have stable coins that I mentioned. So bear in mind that there are different types, and it's not just about money. I think we have a few minutes to touch upon regulations, and then I would love to open it up to questions, because I think that's the most interesting part of this discussion. I will give you a very brief overview here, and I'm not a lawyer. I speak with lawyers on occasion about these topics, but the general points here are that regulations are developing. In many cases, they are far behind the developments in the space. In many cases, regulators are not sold on crypto as a technology, and they are pushing back on it for various reasons. In other cases, regulators are much more open. In the case of India, as you know, there's been numerous new things happening there with the Supreme Court, and then again, the parliament is coming back to fight crypto. My take on it is that no matter what countries do and governments do to fight crypto, there's always another government that is going to be open to crypto. Take Switzerland, for example, or other countries. So in the end, I think governments should understand the promises of this technology and work with it to guide it towards decent applications. Obviously, money laundering is not such an application, but I think countries, instead of dismissing this truly transformational technology, should embrace it and find ways to work with it. And with that, I think I'm gonna just show you one more slide so that you're aware, and then go to questions. I included some resources here, and I think there's a lot here for you to look at, but it's impossible, as I said, to cover this space in 40 minutes. It has many aspects to it. So at the top, I've added some articles as a general background on crypto. Then the Cambridge Associates paper we wrote about the crypto landscape when I was there. A very good resource is Andreessen Horowitz, the famed venture capital firm in Silicon Valley, which has videos and resources for people to understand crypto and the various applications. And then I've added a couple of blog posts that I think are good, and books, podcasts, and a section on Libra, since it's a very big topic these days with in the news and with regulators. So with that, I would love to open this up to questions, and there are numerous. I've received quite a few questions. Let me see.
Sure. Marcos, let me moderate the questions for you if you'd like, or if you'd like to directly jump into the questions, we can do that as well.
Yeah, let let me start with, I think, the more general one, and then I'll let you, Sandeep, take all the others. Is that okay? Because I think the most general one is, I think, the most important question kind of from a big picture perspective. The question is, it looks to me that it is in fact blockchain that is important, but not the cryptocurrency. It depends is the answer to this. What I will tell you is that there are private blockchains that do not really require a crypto asset to function, which could be kind of a consortium of banks or a consortium of corporations that try to pool kind of their resources together and actually create a system that shares information between them in an efficient manner. But that's just one application of blockchain. For public blockchains, though, blockchains that are open to everyone or where everyone can build products upon, they cannot really exist without tokens or crypto assets. They cannot exist without tokens of crypto assets because they can't coordinate the activity of all these decentralized participants otherwise. So I think that public blockchains are an important innovation. Now, a lot of them are really useless. I don't disagree with that. And a lot of these crypto assets are really useless, but there have been very incredibly developed and interesting public blockchains. I would add Bitcoin to that as well, which has had tremendous network effects. And I would add Ethereum there as well and some others. So I think the answer to that is that it totally depends.
Sure. So again, there are certain questions like what is the need for a cryptocurrency as an alternate currency when we can transact with digital currencies as well?
That's a great question. So you have like Venmo and PayPal and things like that, but it's important for you to know that they're not global and they're not really assets. So when a company like PayPal is behind something, first of all, it's kind of specific to every country. Many users of PayPal can't send money to users of PayPal elsewhere, and Venmo and so on. It's all kind of depends on the circumstances. And they also are just really a third party that balances kind of transactions and not the actual dollars. The actual dollars are actually in your bank account. In addition, 1.7 billion people don't have bank accounts, so they can't access PayPal or Venmo or any of these services. What crypto does, what a crypto asset does, it makes the actual asset itself become a bearer asset. So it's exactly like cash that can be settled immediately and can be settled globally with just an internet connection. So yes, in theory, you can do a lot of things with PayPal and Venmo, and you might not need a crypto asset, but the limitations are much broader. And eventually, I think doing it in crypto will eventually, with these scalability solutions being built, will be much cheaper also.
Sure. And just a follow-up question on that, in terms of when Libra was announced a year and a half back, and we can see the pushback from the government that is going to come, it's already come. So why would the governments like to lose their control on a currency like this, on their national currencies?
Yeah,
wouldn't they fight it tooth and nail? And wouldn't they sabotage the entire effort?
They would try to sabotage potentially. I'm not sure they will, because I don't think in America, for example, they're going to do it anymore to ban crypto. They won't, and in many other countries they won't. I think it's very hard to do, first of all, and it's very hard to do because it's a decentralized system, and a decentralized system means that to bring it down, as I said before, you need $6 to $7 billion of computing power to attack. Taking Bitcoin as an example, to attack Bitcoin. So a government to kind of dismantle and destroy Bitcoin would need to assemble 6 to 7 billion worth of computers and start mining. Now, they could do that, but I don't think it would be possible for them to do that without people noticing. And I'm not sure they would want to put $6 to $7 billion to hit that. What governments though can do, and that's an important impediment to crypto, is they can ban crypto exchange to fiat currencies. So they can ban exchanges. They can say, fine, you can own Bitcoin. I can't take that away from you, but I won't allow you to go to an exchange and easily exchange that into cash if you want. I think that governments increasingly will accept certain crypto assets as new forms of assets. So even in the case of Bitcoin, I think I'm taking America as an example. The SEC, the CFTC here have kind of more or less accepted, and they've more or less accepted Ethereum at this point.
Sure, sure. And there are some specific questions in terms of different types of coins that are there. Like, there is a question on a cannabis coin, which is being used for working capital management. And there are other specific questions. What are the different areas that these coins can be utilized? You've covered it in your session as well in terms of utility tokens as well as security tokens. But yeah, can it also be used as a working capital token?
Yeah, there are many applications. I need to caution you on something here, though. I think a lot of the bad publicity of the space has occurred for the following reason. This is an open source technology. What does that mean? Open source means that everybody can cut and paste the code of Bitcoin or Ethereum or any code and create a new kind of similar currency or a new different type of application. And there are two ways this can go. The first way is for people to just launch things that are replicas of others, and that, in some cases, their main purpose is to scam others, actually to raise money from others, and that happened in the IPO bubble. So that's a bad side of it, right? You need to be very careful as to who's behind a crypto asset, which developer community, and what they're trying to achieve. Bitcoin, for example, has had 40 plus clones, and the vast majority of them are totally worthless because they don't have the network effects nor the community that Bitcoin has. And their attempt was just to raise money pretty easily from a group of people. But because of this open source nature, there are some really amazing developers and technologists and entrepreneurs that are actually using this open knowledge to enhance blockchains and to create some very new interesting applications. So in the case of working capital, I don't know. It really depends on the person. I'm not, governments should protect investors from crypto because it's very complex and there are a lot of people that are trying to scam you. That I don't disagree. But there's maybe 5 to 10% of crypto projects out there that can be truly transformational. And you need to have a pretty strong know-how of which ones these are. So the question is, there are many types: working capital, there work tokens, there are payment tokens, there are tokens that are more like mileage points, these sorts of things that airlines have. There are tokens that are more like money, others that are more allow for contracts and insurance, like Ethereum. So the short answer here is that I'm not sure which token you're referring to specifically, but there are many interesting applications, and 90% maybe not interesting.
Great. So there's one more question about the halving process and the effect on the valuation of the coins. And also, would it also have the same effect on stable coins?
Yeah. So the halving is a very simple concept, I think. And, every 4 years, the Bitcoin is a deflationary protocol. First of all, very importantly for you to understand is that Bitcoin was the first blockchain protocol, and it created its own design, and its own design has created certain types of behavior. Now, some of them are not ideal, like the waste of energy. Part of that is because the Bitcoin developers, I think, had no idea how big it would become and how much energy it would need to consume. But in any case, it was an experiment. One thing that they wanted to do is create an asset that has a fixed supply. They wanted to do that because many governments print a lot of money and dilute their currency. So they wanted to create an asset that maintains its value over time. So the way they did this is the following. Every 4 years, the miners that I mentioned before receive half the rewards that they used to receive 4 years ago. Now, in terms of Bitcoins. Now, of course, the price has gone up a lot. So in terms of actual dollars, they're still receiving a lot of money. But what the stock to flow means is that because the supply of newly printed Bitcoins is going to be reduced over time, it actually got reduced more recently. The supply of new Bitcoins coming into the system is much lower. And with increased demand, this should be kind of long-term beneficial for prices, assuming that more institutional investors are going into the space. Because if they maintained the supply they had like 10 years ago, the supply of new coins coming in would be much larger for the demand to absorb. So that's it's a very simple concept. In the case of stable coins, it's different because stable coins are a very different animal. They are pegged to national currencies. The people who are behind them, the suppliers, the miners behind them who are there to support the peg get paid in different ways, but in the end they're pegged to the currency. So they don't really have a new supply. They have a new supply insofar as there's more demand for it, and take Libra, more dollars are backing the Libra dollar. So in the end, it ultimately depends on monetary policy as well.
Sure. And a similar question, can you elaborate a little more on collateral loans, DEFI?
I'm sorry, say that again.
Could you elaborate more on the collateral loans? So like stable coins are there. You mentioned in your presentation about DEFI. DeFi,
yeah. So DeFi is a movement that occurred after really the bubble of 2017. And it's a series of projects mainly functioning on top of the Ethereum blockchain. As I mentioned before, the Ethereum blockchain is a much more complex blockchain than Bitcoin that allows actual code to be written on the ledger. So people can create various types of contracts that can become, very complex. They can become, as complex as having an entire autonomous organization running on Ethereum. So with this development of contracts and with the entry in the space of some experienced entrepreneurs, some new applications started developing that were pure peer-to-peer exchanges, and these involved loans. Take MakerDAO, which is both a loan market but also a stable coin, and it's a bit complex for me to explain it right now. But if you read it, it's worth Googling it. MakerDAO. It's a very interesting project. It allows basically for peer-to-peer lending, and without an intermediary in between. Again, so why is that important? It's important because you cut out the costs of intermediaries. First of all, that's the theory, and two, because people can build more applications on top of it without asking for permission. You would need to ask for permission to a bank to build applications on top of that bank's network, and you'll probably never be granted it. But in decentralized finance, you can have the best mind in finance deciding to cooperate with the best mind in software to create the next application on top of the previous applications. So the view is that there's going to be a Cambrian explosion there of various types of decentralized finance applications. I should note also that because of the effects that I mentioned before, everyone in these networks has an incentive to get this network to grow, the miners, the users, the investors. MakerDAO actually, if you know Lending Club is a company that in its first 5 years issued about 250 million in peer-to-peer loans, but it's done through a centralized way. MakerDAO actually did that in a year's time. And I think a lot of it has to do with the incentives that the various crypto assets give to the various participants to grow the network.
Sure. There are a lot of questions about the risk and investment into cryptocurrencies. So what is your advice in terms of how does the valuation of these coins work? And how does the risk and volatility kind of get estimated in this?
Excellent questions. And very hard questions, because we're talking about a very new technology, right? We are, in my view, at the beginnings of this technology, because all the professional capital and the professional investors came in wave 3, like 2-3 years ago. So the really interesting applications are being developed as we speak. So stable coins are stable coins. So they are just a better medium of exchange than the existing rails, because they're global, faster, they settle immediately. They are equivalent to having physical cash given to each other, but over the internet. And they allow 1.7 billion people in the world who don't have bank accounts to potentially access the financial system. So stable coins is one area. You don't need to value stable coins. They're valued, $1 is 1 DAI in the case of MakerDAO. Now, in the case of Bitcoin, how do you value, how on earth, I would say, do you value Bitcoin? You know, what's its value? And I think there are numerous ways to think about it. If you compare it to a form of digital gold, and why should you compare it to a form of digital gold? Because it functions exactly as digital gold, with the added properties of being much more divisible and much more transferable. If you think of it in that way, one way to think of it is kind of as an asset that will gain some market share from gold. So if you run some numbers, you know, at this point, you will see kind of that gold is about $9 trillion in value. Bitcoin is about $120 billion in value, and you can say, you know, I think given the adoption curve it's had, and given that a lot of younger people and millennials are buying that instead of gold because they are internet native populations, you can say, given this trajectory, which is steady over the years, you can say, you know, in 4 to 5 years, I think Bitcoin adoption will be at 10% of digital gold. That's 900 billion. So we have, you know, 8 to 9x from here to get there. Now, as you can imagine, this is very, the way of thinking about valuations here is very like thinking about early stage venture capital, right? You don't have cash flows. You're just thinking of a market kind of down the road that might be disrupted. You can say also that Twitter, like, or Facebook were just impossible to value at the time, right? They were just doing something different, providing a different sort of function that was superior or different enough, or both, to the existing rails, and who just gained user adoption over time and gained user adoption over time. So I would think of them more in that way, kind of as early stage startups. Now, in the final thing that I want to say is that in the case of work tokens or other more security types of tokens, you can imagine a world in which things are traded via stable coins, and suppliers of various open networks deliver certain services and receive money in stable coins. Now they deliver these services by staking some of these assets that have a certain value, but what is their value? Their value is the discounted cash flows that they're receiving through the stablecoin payments. So they're more akin to securities.
Sure. I like the analogy of digital gold, because the first time Bitcoins were used for a transaction, I believe it was to order 2 pizzas.
Exactly.
And those pizzas would be worth millions of dollars today.
I can't remember
those pizzas were not bought.
I can't remember the figure, but these are certainly the most expensive pizzas in history. They're probably worth today 95. Is it 75 or $95 million?
75 rupees. Yeah, absolutely.
So
something like 800 crores or for 2 pizzas is what the number comes to in Indian currency. So it's about digital gold about, so we have a final 2 questions that we could take before our time is out. But one question that is very interesting to me as well is, what is the progress of blockchain technology in real estate mortgage sectors, especially from a global perspective?
In the real estate market?
Yes.
Yeah. So there are numerous blockchains kind of being created for use cases in real estate. One interesting one, which is more related to mortgages, is called Figure. A project called Figure that it would be interesting for people to Google and learn more about. But it also more broadly with respect to real estate, I think the idea, what a blockchain manages to do is keep an immutable record of transactions through time that can be verified. So there are many countries that titles on real estate are just not up to date, and a lot of titles are missing or are in paper or are lying around somewhere in basements and so on. Now, if you hashed all these records on a blockchain, you could have a permanent record through time, and you could use hashing and a private key to verify that you are kind of the holder of that title. That would make the system of record keeping in real estate much more efficient than it is today, as an example. Another thing is to tokenize real estate assets and make them kind of much more divisible and tradable. This exists to a certain extent with the securitization, but it can be turbocharged with crypto and blockchain technology, where I can, in theory, kind of buy a quarter of your house, Sandeep, and have a claim to a quarter of the value. So it would make kind of real world assets much more potentially. Of course, it's a massive process. It's not easy to transfer all these assets to the blockchain, but it could potentially make them much more divisible, much more liquid. And then if you think about it, make ownership much more pervasive than just the top 1 or 2% or 5% of the population.
Absolutely. So I've dabbled in this space, and I do know that in India, there is a Pune-based company that has done a kind of a pilot on this, and they have fractionalized a property and they have issued the crypto tokens in lieu of that, which are then traded. So, but as we say, blockchain is a foundational technology. It is not really a disruptive technology. It needs mass adoption like the internet to make it successful in the future.
Exactly.
So there are numerous questions, and I apologize to the audience, but I did try to cover as many questions as I could, and some of these questions have already been covered by Marcos, so I will not be repeating them. But I hope I've been able to kind of gist out most of the questions. And with this, I would like to bring this session to a close. And thank you so much, Marcos, for the refresher on crypto, the technology stakeholders, and the transaction mechanics as well. And it was interesting to know about the innovation waves. And crypto, of course, will require many more innovation waves, not just crypto, but also the blockchain technology, which has applications, like you mentioned, across different areas of operations. And of course, the legislation will also have to play a great part. You delved on that as well. And before we close, if you have any closing remarks, you could let us know.
Well, I really appreciate this. I want to say that one of the biggest problems of this space that people should be aware of, and even regulators, is that there are many bad actors. Like in any new technology which is open and anybody can use, there are many bad actors. But it should be important to focus on the good, because the good could be really interesting. And I hope I portrayed this and displayed this. So I think that regulators with fund managers who invest in the space, now the professionals, and also the entrepreneurs themselves should come together. So this is what I will want to leave it at. And I also more than happy if you'd like to get my email from Sandeep and the team to ask me further questions over the coming weeks.
I'm sure that will be really taken on, because there are numerous questions over here which were a little too specific so that I couldn't take them on. And happy to share the email with all of you so that you can directly reach out to Marcos for your queries. And before you close, I would request you to fill out the evaluation survey as well. And the society members can claim their professional learning credit by logging into their professional learning tracking tool. And thank you everybody for your time. Thank you, Marcos. And I would also like to thank the volunteers of CFA Society for making this happen and giving us a platform to discuss on this. Thank you, everybody.
Thank you so much. Much appreciated. Thank you very much.